So let's go to this first tab and hit the plus button. And we're going to go into the inventory quantity adjustment. Inventory quantity adjustment. Let's make it on the 19th. Okay. And so the inventory adjustment account. So where do you want it to go? So the default is shrinkage here. Notice it's still a cost of goods sold type of account, meaning if I say, hey, look, I thought I had 10 units, but some scumbag stole 3 of them, then I'm going to have to write it down, right? So that means that I'm going to have to reduce the dollar amount of inventory, and the other side's going to have to go somewhere. When we sell the inventory, the expense account of selling it is cost of goods sold. But we might want to make another kind of account. We might call it shrinkage, which is the general account, which could include spoiling or theft, or we might just call it theft or spoils or whatever we want to call it. So we'll keep it the shrinkage. I think it's useful to have something other than cost of goods sold because you would like to see the amount of expenses that you are incurring, not for the inventory sold, but for the inventory that was stolen or spoiled, right? So it's good to have it in a separate account. So then we're going to say that the product, let's say that on this one we had the fountain pump. So let's put in fountain pump right there, boom. And so the quantity on hand is 2. So wait a sec. This is a design fountain pump. Let's see, let me do this again. Hold on, there's a bug on my keyboard. All right, I got it. All right, let's try this again. This is gonna be, let's do this one. Design fountain pump. Design fountain pump. This one has 25. Okay, let's say that we counted this one, and now, so this is the quantity on hand, but we say we counted it and there's only 21 of them. So that means there's a change of 4 that has been removed. So then we have down here, we can enter a memo if we want to, we can cancel it, we can clear it, we can save it. And in the drop down, we have save and new and save and close. What's this gonna do when we record it? Well, it's gonna adjust the physical count. So now it's gonna take it down from 25 to 21, which is also gonna have an impact then on the financial statements, which is recorded in dollar amounts. So we're gonna take not the sales price, but the cost of the pumps, because that's what they're on the books for, times the 4 pumps. And that's the amount that's going to be reducing inventory for the adjustment. And then the other side is going to go to the expense, not cost of goods sold itself, because that's for a selling, but a cost of goods sold type of account of shrinkage representing the spoilage or theft. So let's save it and close it and check it out. Let's go to the balance sheet and we'll run it to refresh it. And we'll go into that inventory. Let's go into the inventory here. And we'll say, okay, quantity adjustment. So did it record it? I don't think it recorded. No, maybe that is it. Let's go into it. Let's go into that one, that 40. There it is. Yeah, so the 4 reduction. So boom, there it is on that side. Reduced it in a dollar amount of 40. It was 4 units. Apparently they cost $10 each. That's not the sales price, that's the cost. Let's go back. And then the other side's go into the income statement, because the other side's got to go somewhere. We got to expense it. It's gone. It's part of the expense of operations. It's a cost of operations, but it's not in cost of goods sold because that's going to be the account for when we actually sell the unit. There it is. So I had to refresh the screen again. So it went into inventory shrinkage. So it's still putting it in the cost of goods sold type of a category, but we put it into a different account for shrinkage so we can see the cost of the inventory that has been consumed because we sold it versus the cost of inventory that has been consumed because it was stolen or it's spoiled. Notice that those two things are still expenses, of course. That's the expense of operations. That's the risk we take for doing business in California, right? You're going to deal with shrinkage. And so the question is, you know, can you put that into your business model and still make money with it? A lot of people can't. That's why they're leaving. But that's going to be the idea. So that should be an expense lowering the net income. If we go to the tab to the right and run it again, we're going to say, all right, now the units for the pumps are down to 21. units where they were at the 25. If we pick up the dollar amounts, then we can see that they're $10 each on average. And so we have the total of 556.25, which should still tie out to what's on the balance sheet under the inventory. 556.25, is that what's over here? And we're at 556.25. So there it is. Everything should be tying out. So again, the general rule is with the shrinkage, you got to determine somehow that you're going to deal with shrinkage. Notice that if you have a periodic inventory system, it's hard to deal with shrinkage because the cost of goods sold calculation is going to assume that you sold the units of inventory. So you have to kind of tie out your sales, your actual sales, to the calculation of your cost of goods sold to try to calculate how much of it might have been shrinkage. In a full service system, you have a better ability to at least track how much has been stolen. So you might not be able to stop them in California, but at least you can see how much money you're losing, which might help you to make some decisions on that front. So, and that means that you're going to, that means that you're going to track the inventory perpetually within the system, but still do a physical count so that you can compare what's in your system compared to what's actually physically on ground, and then make those periodic adjustments so that, again, you can at least know what is happening, even if you can't stop what is happening, at least not in the short term.